Let's get started, everybody. Well, first of all, I want to thank you all for coming today. Make sure it's being recorded today this time. My name is Darian Wiggs. It's a pleasure to be in this position to, one, have you all here. And I just want to thank you in advance for your time and everything and sitting here through this presentation when there's 1,000 things you can be doing. So thanks in advance. Really want to make today as informative as possible. So we're just going to jump right into it. So for starters, for those who I haven't met before and those who are here just to learn, as mentioned, my name is Darian Wiggs. I am a licensed certified public accountant, and I am the CEO and founder of Wiggs CPA Tax and Accounting. Launched my business about October 20th of 2022. So although we're about 2 years old, we've had the wonderful pleasure of being able to serve hundreds of people over the last 2 years, and it's something that I'm really passionate about and love doing for people. So as far as formal education, I did graduate from the University of Illinois at Urbana-Champaign, where I have a bachelor's degree and a master's degree in accountancy with a concentration in real estate, right? So after University of Illinois, I started off in corporate America. I honestly thought I found my dream job. So coming from the south suburbs of Chicago, working at the third largest accounting firm in the world, I kid you not, I thought I made it. And then I realized how miserable I was doing something that I didn't enjoy doing. And I wasn't in a position to have a direct impact on my community. So what I did at that time is I took the leap of faith. I quit my corporate job and I went on to essentially start my own firm, which was never part of the plan. But it's one of the best things I ever did because, like I said, my whole goal is to teach as many people as possible, not only just about financial literacy, taxes, and how to be a business owner, but I want to be in a position where I actually can give back. And with Wiggs CPA Tax and Accounting, that's exactly what my goal is, to give back to as many people as possible. So enough about me. Really want to jump into this presentation. I won't go over the agenda because it's a little boring, but the details within the agenda is 10 times better, I promise. So we're just going to jump right into it. So today's presentation, I do this one every year, but it's to pretty much give you a high-level overview of some of the tax changes you can expect over the upcoming year. So as we all know or don't know, you're going to find out today, a lot of the tax code that we know of today is set to change within the next 365 days. We don't know how it's going to change, but it is set to change because in 2017, when the Tax Cuts and Jobs Act was created, back when the Trump administration first started, a lot of the tax laws were created for an 8-year period. Well, this is year number 8. So with that being said, by the end of this year, a lot of the tax regulations and rules that we know of may completely phase out and completely disappear, but I can't give you the answer today because we won't know until the next couple of days, right? Over the next year. So that's just something to keep in mind. The importance of this presentation is just remembering that taxes is one of those things that's going to continuously change, especially with political parties being different. But I wanted to take today to kind of point out some of those changes, kind of go over some of those tax provisions that will be expiring. And then for those who are new business owners or established business owners that just want some refreshers about bookkeeping, payroll, entity structuring, etc., this presentation is pretty much going to give you a high-level overview of how to stay compliant from that perspective. So whenever I talk about taxes, I always break it down to two simple rules, right? In order to win in the game of taxes, you need to understand the rules. That's rule number one, right? I know I got joined in winning team, but you got to understand the rules. I've come to the reality that you wouldn't play basketball, you wouldn't play lacrosse, and if you had a family function, I personally wouldn't play spades if I didn't know how to play. So I always ask my clients, anybody that I know and I'm talking about with money, is why do we continue to approach the game of taxes, the game of finances, right? Our money, why do we continue to approach the game of taxes and finances without knowing the rules? So rule number one with taxes is that you have to join the winning team. And a winning team at the end of the day is being an entrepreneur and an investor. This is not me saying quit your job. This is just me reminding you all that the tax code at the end of the day was essentially created for business owners and investors. Why? Great question. I come to the realization that the government is lazy at times, right? Not lazy, but they're working smarter, not harder. Because think about it this way. The government basically created the tax code to incentivize us to act in certain ways. Yes, the tax code is 70,000 plus pages, but it's not 70,000 plus pages teaching you how to pay taxes. It's 70,000 plus pages of teaching you how to legally avoid paying taxes in a sense. So if you invest in real estate, well, now you're creating housing for the country. Now the government is going to incentivize you to do that by giving you tax credits. If you have a small business, now you're creating jobs. Now they're going to give you incentives so you can actually run and operate your business, hence why there's so many tax deductions for business owners. So Rule number one is yes, taxes can be viewed as the big bad wolf, but if you're on a winning team and if you're here today, you might not be on the winning team before this presentation, but you are now. And hopefully, I want to kind of drill into your brain that you got to understand that the tax code is your friend if you use it the right way. And rule number two is that you got to understand what a write off is. A write off, and I'll explain this a little bit later in the presentation, is pretty much anything that's ordinary and necessary to operate your business. See, the way it works when you have a business or you have a rental property, right? You're an independent contractor. You don't pay taxes on what you bring in the door. You pay taxes on what's left after all in your ordinary and necessary expenses to operate your business. So just keep that in mind. You got a W-2, you're making six figures. Well, we all know that you might make six figures on papers, but Uncle Sam takes his money and then you get to spend what's left. But as a business owner, the equation is different. You make money, you get to spend money, and then you pay taxes on what's left. And if you do this the right way and you plan ahead proactively throughout the year, there won't be any income left to pay taxes on. So those are the rules. Rule number one, join the winning team. Cool, we all here today. Rule number two is that you got to understand the write-off is. But what I want to break down to you all, because this for you new business owners, and just a refresher for everybody, is there's no point in making money if you're not protecting your wealth. The whole point of entrepreneurship, investing in real estate, getting a life insurance policy, stocks, and building all of this wealth for your family is to protect it so that you can pass it on to the next generation or so you can splurge on yourself. No matter what, you need to protect your wealth. So I just want to quickly go over different business structures, but I want to clear the air with these LLCs, right? LLCs, you hear it all the time. It is the most popular entity structure, but I just want to repeat it for you new business owners and for those people who's going to watch the recording. Just to remind you that you do not need an LLC to take business tax deductions. You do not need it, right? You can still, and I'll go over this next slide, you can still take tax deductions. If I decide right now that I want to start a business, I don't need to register it at the state level to start taking tax deductions. So you don't need an LLC to take tax deductions, but you need an LLC to protect your wealth. You need an LLC to build credibility in the eyes of the public and with the bank so you can access business credit. And most importantly, you need an LLC down the road so that you can be eligible to unlock unlimited tax savings down the road. But most importantly, you have that S Corp insurance, which I'll talk about shortly. So I just want to clear the air. LLCs are fine, but especially tax time. You drive Uber, you drive Lyft, you do hair, you got a landscaping business. You don't need an LLC initially to get those deductions. So I just want to highlight that because I get it all the time and people miss that on their tax return. So I want to take this time to walk you all through the journey of what it's like when you start a business, right? Step number one, anybody and everybody here, when you first have a business idea, you start off as a sole proprietor. Everybody starts off here. And I'm going to announce now I'm selling calculators as of 2 seconds ago. I'm not registered at the state level because I just told y'all, but the way it works is I'm a business owner. I sell calculators now. So all I need to do is make my first sale and I can start taking the same deductions essentially as somebody could with an LLC. The problem is, let's switch it up. If you got a business and you're a sole proprietor, and let's say you got a rental property and somebody slip and fall within it, well, because you are a sole proprietor and you're not legally protected, even though it's free to set up, even though it don't cost no money at all in the initial stages, well, now you have full liability. So if somebody were to slip and fall, or somebody were to sue you within your business because their kid choked on something within your daycare, right? See it all the time. Well, now your personal assets are at risk. So that's all your brokerage accounts, your personal car, your home, your kids' savings. Like you don't want to be in that position ever in your life where it's like your business, which is supposed to be a whole separate legal entity, is putting you at risk of losing your personal assets. So starting off as a sole proprietor is perfectly fine. Everyone starts there. But the moment you're like, all right, I'm gonna start taking this business to the next level. I want to brand it. I want to market it. I want to start establishing business credit. Now you're in a position now to set up a limited liability company, which is an LLC. LLC is crucial. Sorry about that. I'm gonna cough a few times throughout this presentation. LLC is crucial because now once you have an LLC, that's the most popular entity structure that most people start off with. It's relatively inexpensive. It's easy to set up. But once you do that, like I said, you'll be able to take the same tax deductions, but now you're protecting your wealth. And that's the most important part here with the LLC is that you want to protect your wealth over the long run. Sorry about that. Give me a second. So with the LLC, the one common thing I see all the time is that people miss out on a lot of their expenses. And the reason why is because they're not doing it the right way. You see, one rule with this limited liability company is that, sorry, Bill, can't even think. If you have a limited liability company, LLC, you lose out on that limited liability that you sign up for if you're not separating business and personal finances. So keep that in mind that if you have an LLC and you're commingling funds, you're piercing the corporate veil, we're using your business account for personal expenses or personal for business expenses, you're not supposed to do that with an LLC because your entity is supposed to be a completely separate entity from yourself. I see it probably 85% of the time. It's very rare for me as an accountant to have a new client who is doing this initially. So if this is you, it's a fresh year. If you want to get that limited liability protection that you sign up for with the LLC, you need to separate business and personal finances and realize that your business is a separate entity. So that's that on that. S corps, quickly want to touch on that. That's a tax election status. Where a lot of people get confused, like, oh, I want an S corp. Do I need to create a new entity? No, an S corp is a tax election status. That's pretty much you telling the IRS, I'm making good money within my business, but I want to save on taxes. Now, how do you save on taxes? You see, when you're an entrepreneur, we pay federal tax. In Illinois, if you're making six figures, let's say you're around the 24% bracket for the federal, you got to pay 5% tax to the state of Illinois. You're at 29. And then this thing called self-employment tax. That's your Social Security and Medicare tax. That's 15.3% extra. So you do the math, you're looking at close to about 40% of your income is going towards Uncle Sam, which means about 40% of the year, you're pretty much working for free. However, in this case, if you got an S corp, you don't pay self-employment tax on the net income of your business. You'll have to pay yourself a reasonable salary, but your ultimate tax savings will come from the fact that you won't have to pay Social Security and Medicare taxes on the vast majority of your income. So S corp isn't for everybody. It's an amazing tax savings machine, but don't think about it and don't consider it until your revenue minus expenses is north of 40 to 50,000. Then it's time to talk about it, because when you have an S corp, there's additional expenses that come with it that kind of take down the savings a little bit. But ultimately, you start off as a sole proprietor, you go to a limited liability company, and then you graduate to an S corp. C corps, the vast majority of us don't need one unless you're trying to go public and sell shares, turn into Alphabet, Tesla, right? You want to go to the Nike and you want to sell shares to the public. Or if your industry requires it, then a C corp may be the route for you. But for the vast majority of us small business owners just getting started, LLC is all you need. And in a corporation, something you could talk about down the road, but initially you don't need it because you're just signing up for double taxation. So that's business entity structures. I always like in the beginning of the year laying down that foundation, because I get a lot of clients who come to me and they have like 7 entities set up already. And then they don't even know the flow chart and how things go, or they don't know how their entity is set up. And just know that all of these are taxed differently. So it's very important for you when you register in your entity and as you're filing your tax returns that you know what type of entity you have. That case, you're not getting penalized. So that's that on entity structures. Now that we know how to protect our wealth, I want to go over what a tax write-off is, right? And the more and more I do this, I realize that a lot of you are catching on. So it's good, right? Remember, a write-off is anything that's ordinary and necessary to operate your business. That's the most important thing you need to think about when you have a business. And guess who gets to determine if it's ordinary and necessary? You do. So depending on what industry you're in, there may be an expense that's ordinary and necessary for you to operate your business. And I can't write it off because it's not ordinary and necessary for me. So just know you got to think from your shoes as the CEO of your business. Why am I spending this money? Did I spend this money with the intent to make more money? Did I do this for marketing? Did I do this to get a client? Like, think about it from that perspective. And that's how you get to understand what a write-off is. And remember, a write-off is a tax deduction in the sense where if you made $100,000 and you got $20,000 of write-offs, you don't pay taxes on $100K. You pay taxes on the difference, which is $80,000. So that's a write-off. Ordinary, necessary. You can take it on your tax return. Now, one thing I want to point out for the new business owners here is that you got to realize that a lot of your personal expenses automatically become deductible the moment you have a business, right? You need your phone to be available for clients. You need your internet. Hey, everybody, we're on the internet right now. You need to eat, right? You got to meet with clients. You go to trips. A lot of us are working from home. You get the write-off portion of your rent, property taxes, mortgage interest, travel, car expenses, Apple Watches, like pretty much everything that you already are paying for, a decent percentage of it automatically becomes deductible the moment you have a business. And this isn't me saying, oh, go splurge and buy a new phone, go upgrade to AT&T and get cable, go travel to, no, like These are things you're paying for already. But if you're a business owner, think about how you can make these things ordinary and necessary and also can add on to the value of your business. So that's the daily deductible expenses. Some of my favorite deductions, and I'll send this to all of you after this presentation, are some of these ones that's bolded, right? I think auto expenses, self-explanatory. I'll explain that a little later, where it's either you get 67 cents per mile or 70 cents this upcoming year, or you can write off a percentage of your actual auto expenses, gas, oil, repairs, but it's all based on the percentage of your car that's used for business. But my favorite two or three I want to highlight is retirement plans and compensation and salary. Compensation and salary, and like I said, this is a tax update. Just want to remind you all that every year when you file your tax return, you get a standard deduction. So if you're married in 2025, you get an automatic $30,000 deduction on your tax return just for being married. Now, for you single folks on paper, you get an automatic $15,000 deduction just because you're filing your taxes. Automatic. That's what the standard deduction is. Now, what that means for you as business owners is, remember the strategy where you could pay your kids. Each year, this number is going to increase. It went up from 14,600 to now it's 15,000. It's going to increase every single year. But just a reminder that, yes, you can write off paying your contractors, your W-2 employees. But if you're making a lot of money and you do have kids between the ages of 6 and 17, well, this strategy can be very useful for you because you can transfer up to $15,000. Got to do it the right way. You got to have a bank account for your kids. They got to actually be working within your business. But imagine if you got 3 kids and you paying all of them $15,000 a year. Not only are you getting a $45,000 deduction, but now they're getting a tax-free income. And if you plan this out the right way, they can put that in a Roth IRA to invest that down the road for future expenses. Or you're the parent, and y'all know better than me, I don't have kids. You got to take care of them anyway. How about you use some of that money, get a tax deduction for it, put it in your kids' account, and now you're using that same money to take care of them like you've been had planned anyways, right? So that's one thing to keep in mind, that the standard deduction did increase. That's going to impact everybody's here tax return, regardless or not if you have a business. The other one is retirement plans. I like this one a lot because I always highlight that the moment you leave corporate America, it's kind of hard at times when you start your own business because you lose out on a lot of the benefits, right? Health insurance, retirement accounts, a lot of free trips and stuff like that. If you splurge, I miss it sometimes. I'm just playing, I don't. But long story short, I do miss the 401k because the reason why is because your employer typically matches the money you put towards it, right? And as the employee, you could put up to like 23,500 towards it. Now, as a business owner, I just want to remind you that don't let that deter you, especially if you're thinking about leaving your job, like I'm gonna lose out for benefits. Just want to remind you that the IRS, as a business owner in 2025, allows you to allows you to contribute up to $70,000 towards your retirement account if you are the sole owner of your business and you are the only employee, right, other than your spouse, where you can contribute up to $70,000 towards a retirement account. Not only will you get a tax deduction, but now you're able to build wealth 10 times faster than the average American. So keep that in mind. A lot of times, let's be real, in the early stages of your business, it's very hard to build a business and put money up for a retirement account at the same time. But as your business start growing, you have that excess cash flow. Keep in mind, SEF IRA, solo 401ks, you can put yourself there, get a retirement account that's going to help you in the future and also get a tax deduction today. And one quick thing I like to add is with a SEF and a solo 401k, yes, 2024 is over already, but some of these accounts, if you have a profitable business and you paid yourself a salary last year within your business, you may be eligible to set up an account today, contribute up to $69,000 from last year, and get a tax deduction to offset your taxable income. So you still can set this up today and get the tax deduction, but you got to plan it out the right way. So those are my favorite deductions. I'll send y'all a whole list of a lot. I always mention educational books because you can't write off going to University of Illinois or Harvard. But if you're paying Elon Musk, Grant Cardone, Jeff Bezos, $10,000, $20,000 for one of their masterminds of courses, just keep in mind as a business owner, those things are deductible. Why? Because they're ordinary and necessary. You're growing your brand, you're learning how to scale and grow your business, and you're becoming a better CEO for your employees. So that's a quick spill on deductions. I do want to kind of see if anybody have any questions. I know we have to in the middle of the presentation, but does anybody have a question you want to kind of come off mute and jump in the chat? I'll be happy to answer it. And if not, no worries. I'll definitely gonna open the floor up towards the end.
Hey, can you hear me? I'm driving, so this Tabitha. Can you hear me?
Yep, I can hear you.
Oh, okay. Quick question. You did say about the deduction for kids. What if your kids are over 21? My daughter's 19,
Mhm.
and I was trying to see if it's anything I can do with that, or it's only for under 16.
Yep. So under 17, you're in a unique, and it's all based on how your entity is structured, whether it's S Corp, a single member LLC. But if they're over 18, then it gets a little trickier, but it's still possible. Instead of paying them as a W-2 employee, you may have to pay them as an independent contractor, where it's like they still will have to pay taxes. But if you're making $200,000, you're in a higher tax bracket versus your kid who is like in a 10% tax bracket. So you'll still get a tax savings, but you're shifting income to a lower tax bracket. That's pretty much how you want to look at it. And then if you're paying them as a contractor, now your kids are able to take all the tax deductions we just mentioned, right? If they're in college, business mileage coming back and forth, Greyhounds, Amtrak's, meals with you, like they'll be a business owner in a sense themselves. So even if you're giving them $10,000 and they have to pay taxes on it at the federal level, just keep in mind that your kids are able to take deductions too as well. Does that kind of answer your question?
It does. Thank you so
Mhm.
much. I appreciate that.
Yeah, no problem. And like I said, this sound is simple, but depending on how your entity is set up, you may need a family management company and you want to create a paper trail for this. And that's the best way to go about doing it. So I think that answered that question. I'm gonna keep going, but if anybody else has questions too, I'm definitely gonna open the floor up towards the end. So that's tax deductions. That's how to protect your wealth, right? Next, I want to quickly go over to you all some bookkeeping best practices, right? Our firm started accepting new bookkeeping clients a couple months ago, and it was a wake-up call to a reality check. It's just how it is with bookkeeping and reality for most business owners. Because a lot of times we be so locked in and focused on just making money, reinvesting back into our business that we forget the importance of understanding the numbers within your business. So I just want to go over some quick best practices. Normally, I'm just like, get Excel, get QuickBooks, but I want to kind of go over why. Step number one, reason number one is that it's to stay compliant. You can take all the deductions I just said. You can pay your kids. You can buy a car. You can go to Miami for a business conference or Vegas and run it up for your business. But the moment IRS come knocking, if you don't have a single receipt, well, now you're getting audited. And now not only are you at risk of losing out all the deductions you owe, but the IRS can be like, well, you owed us this money a year ago and you lied. We're going to tack on late filing fees, interest fees. I guess it's not worth it. So this is just a reminder to you all to keep track of your business receipts, especially for those material expenses for at least 3 years. It's not like the older days. I remember my auntie used to have receipts in a garbage bag in the back seat of her car. You don't need to do that no more, right? Take a picture, email it to yourself, added the QuickBooks, but let's get in the habit of keeping these receipts, especially for larger expenses, because you don't want to get in trouble down the road. On top of that is I need to remind you all just to continue to separate business and personal finances. And trust me when I say 85% of people I work with, they don't do this. I'm not blaming them. I just want to remind you all that's here today is that it's worth the investment. Because not only is tax season about to be a headache for some of you, because now you got to go through your personal check-ins, your business check-ins, and categorize it. I guess a headache by itself. But if you have an LLC, just a quick reminder that that LLC isn't relevant and it doesn't help at all if you're commingling funds. So you got to separate finances. You got to keep business receipts. And the reason why I say that is not just for taxes, but you want to track the performance of your business. Yes, you need that audit protection, but if you want to grow, you need to figure out what your margins are. You need to figure out what your profit is. You need to figure out where you put the majority of your money so you can know how to move differently. So that's attractive performance. You can easily start off with Excel with this. When I first started my business, before I launched my business, when I was doing it on the side, Excel was my best friend. And I highly recommend it if you're just getting started. Once a month, twice a month, just categorize your transactions, have something. But the moment it starts taking up a lot of time, the moment you start scaling, the moment you start making good money within your business, QuickBooks is a simple solution, right? There's not a plug for them. I don't get paid, right? But QuickBooks is so easy when you just link your business and checking account. And if you have a business where it's just simple operations, it's super doable, right? You can do it yourself. You can hire somebody on Fiverr, or you can reach out to a bookkeeping firm like ourselves and we can take care of it because QuickBooks, they make it sound easy. But the moment you start taking out loans, the moment you got to start dealing with payroll, you got to start dealing with accounts payables and credit cards and all. Accounting can get very, very complicated. So it's not as easy as checking the box. But in the early stages of your business, just having that set up so you can get a snapshot of the actual performance of your business, that's the way to go. So that's why I say bookkeeping, hopefully best practices, save receipts, separate business and personal finances, get in the habit of tracking your business activity. Because as a business owner, like I said, W-2 employees got it good at times because they make money, IRS takes money, and then they pay taxes on what's left, right? Us, like I said, we make money, we spend it, and then we pay taxes on what's left. But IRS still wants money from us, so we need to make quarterly estimated tax payments, right? Every 3 to 4 months, April 15th, June 15th, September 15th, the end of the year, we're required to make those payments. And the way you do it is you look at your profit and loss statement. You look at, okay, I brought in 10,000, I spent 6,000, well, I owe taxes on $4,000. Illinois, 5% go to them. Look at your federal tax rate based on your projections for the year, and you send a payment into the IRS. That's how we're supposed to do it as business owners. So I just want to kind of go over some best practices there, just to remind you all that bookkeeping is essential. And if you need some assistance during tax time with some questions or got questions towards the end, I'll be happy to answer those. But that's for bookkeeping. Next thing here is payroll. I'm gonna make this short and sweet because payroll is one of those things that get overlooked a lot. And this is a quick reminder because as a business owner, and I'll go over this in 2 slides from now. We have requirements to send out any W-2s and 1099s to our employees or our contractors that we had throughout the year. So if this is you, you're a sole proprietor, single member LLC, or you're in a partnership and you're not getting guaranteed payments, you do not need to issue yourself a W-2 or 1099. Don't do it. You don't have to. Now, if you are already running payroll, you're a little too late. But this year, if you're in a partnership, single member LLC, or sole proprietor, and for those of you who just jumped in, you don't have a business register at the state level, don't run payroll for yourself because you're going to get taxed on the net income of your business no matter how much you pay yourself. So don't run payroll. The way you pay yourself is an owner's draw. It's literally the process of transferring money from your business account, because now everybody here has a business account, to your personal account, and then you do whatever you want to do with your money. Right? It's not a business expense because you don't get taxed on the net income, but just a friendly reminder that you don't need to get yourself a 1099. I see it all the time, especially with those of you with different business structures throughout the year, single member LLCs, sole proprietors. Like, just keep this in mind. Now, if you have an S Corp or a C Corp, the rules are different. C Corp, remember, you're taxed twice. You pay 21% tax on any income your business makes, and then you got to pay yourself, boom, you're getting taxed again, right? Dividends, or you pay yourself as a W-2 employee, that's different. And an S Corp, and for those of you with an S Corp, when the year is over, but just a reminder that you have to pay yourself a reasonable salary. You have to run payroll. I said earlier that yes, you would avoid 15.3% of taxes, that self-employment portion on your net income. However, you have to pay it on a reasonable salary for yourself. So this is a reminder: sole proprietor, single member LLCs, partnerships, no W-2s. In 2025, I just want y'all figuring out how much you need to live after, well, pay yourself first, right? That's another conversation. But figure out how much you need for your business, figure out how much you need to survive, and just do a transfer to pay yourself. So that's payroll. I'll be happy to answer some of those questions related to it towards the end. So now just want to kind of go over some key tax changes, right, that I think are super essential. This list could have been 40 pages. Because those who just jumped in, like I said, the entire tax code that was reformed in 2017 is set to change by the end of this year. So the major change that I think, and it's not the major, it's not the biggest, but it's going to impact everybody here, Republican, Democrat, I don't care what side of the straw you're on, the tax rates are set to increase for everybody. Right now, the highest tax rate is 37%. Now it's going to go up to 39.6%. Cool. That's for the wealthy folks. All right. If you here and that's you, trying to get like you when I grow up, right? But for the middle class folks, even so, right now, your tax rate may be 22%. It may be 24%. Well, look at God. Look at that. That's terrible. Your tax rate is going to jump up too as well, from 28 to 33%. So everybody is going to be impacted by these tax changes. Again, don't know if they're going to change officially, but that's something to keep lookout on, that your tax rate, aka your refund, or your tax liability may have a 5 to 10% swing within the next year. 2025, we're in the clear, but just keep in mind that these things are going to change, which the reason why I bring it up, because if you know your tax bracket is going to increase next year, then a lot of the tax strategies, backdoor Roth IRAs, selling stocks, selling your home, different things that's going to create taxable income for you. You might want to do it in 2025 if you know your tax rate is going to go up, just to reduce your tax bill over the next 2 years, which is another conversation. So that's one thing to be on the lookout for, is the tax brackets. Number two is you basically want to look out for bonus depreciation. Now, When I first started doing taxes fresh out of school and I got on social media for the first time, this was everywhere. And for those who don't know, bonus depreciation is, I guess the best way to put it is, it's an expense that you get and you don't necessarily have to spend money. For an example, I'll use a car. You buy a car that's $60,000 and you put 10,000 down. Let's say that car was more than 6,000 pounds. Where in 2021, you can write off 100% of the purchase price of that car if it's 100% for business purposes, and you only put 10,000 down. So that's how depreciation works. But the IRS allows to account for the deterioration of a rental property or a car, like an asset within your business, but you're not actually spending the money right away. So that used to be at 100%. In 2025, it's at 40%. And next year it's going to be at 20. And all those G-Wagon write-offs and cost segregation studies that sound so good on the internet, those may completely phase out. And the reason why I mention that is that it's not just me telling you all take advantage of this in 2025. But as you start planning on how to reduce your 2025 tax bill, as all of us are growing our businesses this year, you want to keep in mind that if you want to take advantage of the tax code, one, keep up to date what's going on. I know it's wishy-washy and it keep changing, but I want you to be aware that some of the strategies we normally know won't be there, right? The last two I want to quickly touch on is the qualified business income deduction. Does anybody know about the QBI? Have y'all heard of it? Can y'all put in the chat yes or no? I'm just curious, with the exception of Kevin. The QBI deduction. Has anybody heard of it? Teach me. All right. Okay, Kevin. All right, here we go. All right. So the QBI deduction, and it's one of those things that it's super beneficial for us business owners, but I don't think we did a great job of explaining it when it initially happened. Because the way it works is when the tax code was changed in 2017, right? Maybe TMI, for those larger corporations in America, their tax rate went from 35% to 21%. So then you ask yourself, how is that fair to me? How is that fair to you? How does these large corporations continue to get these tax deductions and us, us little big guys, we're stuck with the tax bill. So the QBI was a 20% tax deduction that all of us got if you qualify and made a certain amount, a 20% deduction to offset our taxable income. That's what most of us got, but that's set to expire. So if you're looking at the tax rates already going up, the QBI deduction going away, well, business owners, we might be in trouble. We might be in trouble because a lot of those back-end tax deductions, they may be eliminated, right? On top of that, if you got kids, that $2,000 tax credit we think y'all been getting and running up, that's going to decrease to $1,000. And if that tax credit is decreasing, if it makes it sound even worse, if you were making $200,000 and you were single, you can get this credit. If you were making $400,000 and you were married, you can get this credit. Now, if it goes back to 1,000 per credit, now they're like, if you make more than 75K and you're single, you're not getting this credit. If you're making more than 150K and you're married, you're not getting this credit. So this is just four things. I can keep going on and on, but I want to emphasize that no matter what side of politics you're on, no matter what side, business owner, W-2 employee, please take some time to investigate some of these tax changes. I'll do webinars throughout the year to let you know what changes, but I wanted to point some of these out. Now, the truth behind these, like I said, most of these are set to expire, and not to go to politics. Luckily, in this case, all of these were changed in 2017 when the Trump administration first started, with the expectations that he was going to win for 8 years, and then they were going to expire, and then a new set of Republicans and Democrats make the changes. However, we all know what just happened. 4 years on, 4 years away, he's back. So, with that being said, a lot of these changes that were set to expire, he never had control of. Now the Trump administration is back, so they may keep the vast majority of these. But just to get a little deeper here is that it's not as easy as it sounds. And yes, I'm one of those people. I don't want anybody overpaying their fair share of taxes, but just keep in mind that a lot of this stuff, it's a lot of pieces that go into it. Because as all these tax deductions keep going in, that means the U.S. deficit is growing higher and higher because we're not getting that much tax revenue from the people who live within this country, right? So when I say that is to say that they're going to make changes. They're going to keep some of these, but just keep in mind that they're going to keep some and change some because they're going to try to balance it out as best as they can. But this is just me reminding you all just to stay up to date with it and reach out if you have any questions. So that's pretty much it on the tax changes. We can go over those in more details in the Q&A, but I want to quickly go over some tax deadlines. Number one, I highlighted this because this is fresh, new. As of 2, 3 days ago, the IRS is officially accepting your 2024 tax returns on January 27. I'll send out an email for those of you who need some tax prep services and help. But January 27, which is in the next 13 days, that's when the IRS is going to start accepting returns. So if you try to get your tax returns filed in November or December, all of those that were electronically filed, they're going to get pushed through on January 27. And then now we can start officially filing your 2024 tax returns too as well. If you have an S Corp or a partnership, that deadline is March 17th. And I'm going to say this, please don't miss that. I didn't realize it until this year that I knew the numbers. But like if you miss it and you have multiple partners, that can be the easiest $5,000 fine you will have to pay, even if you don't owe money to the IRS and you forget to file your S Corp or your partnership tax return on time by March 17th, you're looking at a couple $1,000s just for not filing. So you want to file before the deadline. And remember that if you have a single member LLC, that's an LLC owned by one person, you're a sole proprietor, you're a contractor, you drive Uber, Lyft, you cut hair, you dog sit, you got a C Corp and your personal tax returns. All of these are due April 15th. And the reason why your partnership and S Corp tax returns are due first, because you get a K1 showing your percentage of income. So let's say me and Kevin is in a partnership. We make $120,000 for the year. I get a K1 showing my 50% ownership. He gets a K1. That K1 would say Darion is responsible for paying taxes on 60K, Kevin for the other 60, and then you file your personal tax return. It gets added with your other income from all other sources, and then it determines your tax rate. So keep that in mind. I mentioned this earlier, but if you have a business, you got W-2 employees, you got 1099 contractors that you pay more than $600 to, please issue them a 1099 or a W-2 by the end of the month. And well, those of you with the W-2 employees as well, your employer you probably won't get your W-2s until the next few weeks, but just know that the deadline is January 31st. So don't panic if you don't have it by then. It should be to you by the first week or two of February. I normally see a pickup in tax calls and taxes become extremely important mid-February. I always say after the Super Bowl, first of all, those TurboTax commercials. And then two, that's when you should have most of your documents. So just keep that in mind. And then the last two, estimated taxes. Definitely want to take care of that. As I mentioned, you pay taxes on what's left, and you need to get in the habit of doing this on a quarterly basis. You need a business checking account. You need a business credit card. And I also recommend for you to set up a separate tax account. Yes, you don't have to pay taxes right away, but if you get in the habit of saving 15, 20, 25% of your income and putting it in a separate tax account, when it's time to make these estimated tax payments, you have that money saved up. The reality is, I don't want anybody here to pay more than their fair share of taxes. But the real reality is if you want a mortgage, you're trying to get a loan for a car, you're trying to get pre-approved for something, you need to show income sometimes, right? And it's hard to avoid it. So if you know you need to show income, pay those estimated taxes. So instead of waiting until March and realize, oh, I owe them 20K, I don't want that house no more. No, if you know you want to buy that house next year, start showing income now on your taxes and make those estimated taxes. Lastly, BOI reports. I'm going to make this extremely quick because they are annoying me. BOI reports last year, if you haven't heard about it, it was required all of last year to be completed by January 1st. Otherwise, it tried to scare us with a $10,000 fine. December 5th, the judge in taxes was like, no, it's not required. Cool. They delayed it. A week later, they was like, you know what? It's required now. The deadline is January 13th. 2 days later, they was like, no, now it's voluntary. My professional opinion, the form is free. It takes less than 5 minutes. If you have a business, just knock it out. If not, you're not going to get penalized. However, if they change the rules within the next few weeks and change the deadline to March or February 15th or something like that, now you got to file it. So just my last spiel on that. I personally just say file it. The reason why they got rid of it is because your personal information be floating around. Well, it's already on the internet, people. They want to know your name, your address, and where you live. Well, name, address, picture, your ID, and that's pretty much it. But those are the major deadlines. Let me know if you have any questions. Lastly, just to wrap it up, just want to let you all know that tax season is here. We are helping out if anybody need any tax preparation services from today up until April 1st.
Yes.
So, yeah, got you. What was that, Narisha? Oh,
On there to
I
talk to
got her.
her.
There you go. Okay. So yeah, if you need some tax prep services, we are accepting new clients over the next 3 months, and we're stopping on April 1st. So if you're trying to get a file right away, let us know. And then for those of you who are business owners, our primary service that we do throughout the year is we specialize in working with business owners who provide a service to the community. Our goal is to provide a service to you by taking care of your taxes, your bookkeeping, your payroll, but most importantly, we strategically sit down with you throughout the year and help you proactively reduce your tax bill. There's two different tax seasons. Right now, we're in tax prep season. You come to me, your 1099s, W-2s, I'm going to tell you what you owe. I'm going to try my best to give you some strategies, but it's very hard to strategically reduce your tax bill in 2025 when you're trying to file your 2024 tax bill. So what we do with business owners, we create a customized plan for you, hold your hand throughout the process, and make sure you implement that throughout the steps. So that's pretty much us. Hopefully you all learned something from this presentation. I'm going to open the floor for questions, but feel free to stay connected. This is our website, wiggscpa.com. We try to post videos, information about taxes all the time on Instagram at Wiggs CPA, and know that we are here to help. So thank you all. I'm gonna open the floor for some questions to see how we can help. But yeah, thank you all for your time.
Yeah, what was
And
that
feel
other
free to
word?
come off mute, drop something in the chat. Let me know how I can help.
Okay, so I have a question.
Okay.
The business account transfer when you're paying yourself,
Mm-hmm.
should you label this transfer like say you selling from your personal account, from your business account to your personal account? Do you label this as payroll so
Yep.
that reconcile or QuickBook will know or
Mm-hmm. So the best way to do it, if I'm assuming, do you have a single member LLC?
yes.
Okay, so if you have a single member LLC, remember that you don't have to issue yourself a W-2 or 1099. So when you do pay yourself, that way you would just go what is called owner's draw. And when you do it, let's say you want to pay yourself $2,500 a month from your business, once a month, twice a month, however you want to do it. When you do it, just make sure in that memo you put owner's draw so that you can know.
Owner's draw.
And then your bookkeeper would know, or you would know when you do it, it's not a business expense because you're going to get taxed on the net income of your business no matter what. That is going to go on the balance sheet. Not to get too technical, but when you take money out as an owner's draw, it's going to reduce the equity within your business, which isn't going to impact your income and expenses at all. So just make sure that you clearly label it. And in your bookkeeping, hoping you're working with somebody that's knowledgeable about it, they should know to do that route.
Okay, thank you.
Yep. And Amy, I'm asking your question. What exactly is the BOI and why would I need to file one? I'll make it quick. Basically, as we all know, PPP loans, a lot of fraud was going on during the pandemic. Really want to go there. Drug dealing, sex trafficking, a bunch of nasty stuff gets done behind LLCs. And the IRS never had a way to track it. Because when you register your business, you register it at the state level. So Illinois may know who your registered agent is. Illinois may know where you live, but the IRS never had a database saying Darion Wiggs is the owner. He lives at this address. We can find him if we need him. So the IRS, the fencing, right, which is a sister agency of the government, was like, we need to create our own database. So now if you have a business, fill out this form, takes 5 minutes, tell us your name, give us a picture of your ID, and let us know where you live. That's it. And the reason why they said, let's do that, we're going to scare away a lot of people who have been committing fraud because they're not going to report themselves and we're going to charge them $10,000 until they come out of the closet. That was their logic behind it. But as I just said, you're giving up a lot of confidential information in a sense. So the judges and courts kind of been going back and forth. But that's the BOI report. It's not to add extra to our plate. You really just got to complete it once and only update it like when you move or like change locations, change your business name. But in a quick sense, that's what a BOI report is. Does that help out a little bit, Amy? And I'm assuming we probably driving or something, but that's the BOI report. Any other questions about anything, anybody? How do you navigate balance between maximize legit deduction for your clients by showing conservative approach? Max, you want to come off mute by any chance? Break that down a little bit to me.
Yeah, I mean, a lot of clients will come to you and, try and look for every deduction that they could possibly get. And, someone might be a little bit more aggressive than what you might be willing to, go along with. So, um, sorry about that. How do you, kind of navigate, that balance between the two?
Okay, gotcha. So like those clients who like, I don't want to pay anything at all. I want to write off everything in a book.
Exactly.
Like how do got you. So at the end of the day, it's gonna sound bad. It's your tax return, right? If I'm doing your taxes, And the perks of me being an auditor in the past is that if I see any red flags, I'm asking questions. And if it's something that I'm not comfortable with filing, best believe my 5 years of college experience, CPA license, 4 years been, I'm not going to risk it all for nobody. So that's how we go start. However, I am as aggressive as you want to be, but if we do take the aggressive route, we're creating a paper trail for everything that we do. It's okay to be perfectly aggressive and fine, but don't go to your accountant or your CPA on March 15th and be like, I don't want to pay anything. How do I reduce my 2024 tax bill? But buddy, not only do you have 2 days, but there's no way in the world we can create a paper trail and actually follow the tax code the way it's supposed to be followed to reduce your tax bill. It's perfectly fine to be aggressive. I'm aggressive too as well, but it just those who want to take advantage of the aggressive tax deductions, those are the people who need to be doing it proactively throughout the year through our business services or working with a CPA a few times throughout the year so that you can reduce your tax bill versus those who are just trying to do it all at once. Does that kind of make sense, Max?
Yeah, definitely. I definitely get that. Thank you. I
Mhm. Yeah.
appreciate that.
Yeah, no problem. Yeah, I'm all for not paying, but it's just gotta go about doing it the right way. So my goal is to never get anyone audited. And when I prep taxes too as well, even for business owners, because I work with so many business owners, I compare everybody's tax returns to the industry averages too as well. So say for instance, I'm doing your tax returns, I realize your meal is only like $200, but everybody else and wrote off 2, 3 thousand. I got a few questions for you because now it's like, all right, what happened? Are you starving yourself? But I like to dive
Right.
deeper into the financial statements and try to nitpick at things we can add to your tax return. But yeah, like I said, the goal is to avoid those risks, but also be aggressive at the same time.
Okay. Okay. Thank you.
Yep, no problem, no problem. And Amy, I'll try to drop that link in the chat so you can have it, or I'll send it to your email. Any other questions about taxes, entity structuring, updates?
Hey Darion, can you hear me okay?
Yep, I can hear you. How's it going?
Pretty good. I want to make sure that I'm understanding bonus depreciation. So going back to like your car example, say that I do put down the 10K
Hmm.
and have 50K left to finance. I'm just wondering how the cash flow works with the tax benefits for bonus depreciation. Like I understand you can write off the remainder of the loan, but you still need to make payments. So how do the tax savings compare to the interest rate and the cash flow that I would need each month?
Yep, no, that's a great question. So the interest on the loan, you could deduct that as you pay it. Any other expenses associated with the car, and this depends on like the size of the car, but like if you're paying interest, you paying oil, gas, those things you can write off right away. But like the $50,000 you have to pay on that mortgage for the car, the perks to it is that, yeah, you might have put down 10K, but the deduction can be a lot higher on your tax return. But I think to kind of answer your question in a sense, I know that sounds like a big deduction. The rest of it can get spread out. Well, one, you don't have to take bonus depreciation if you need to show a little bit more income. You can elect to just have the car expense spread it out over a 5 year period. That's the alternative route. And one thing I want you all to keep in mind too is a unique thing about depreciation is that let's say you want to get a mortgage, you're trying to apply to real estate. And if you go to a good lender, they see that you do have a $50,000 depreciation expense. Well, based on what we're talking about, we all know that you didn't just spend $50,000. So the lender should be able to add that back to your tax, to your net income so that you can show more income. So as far as cash flow, probably have to get a little bit more deeper into the numbers, but as a holistic, did that kind of answer the question a bit, Jay?
Yeah, that's helpful. Thank you.
Yeah, no problem, no problem. But yeah, depreciation's one I love it because I call it like an invisible expense in the sense where it's like you're not actually spending the money, but you're taking advantage of the tax benefits. Because the IRS just makes you spread it out because it'd be very difficult if you could just write off like $400,000 on your tax return in 1 year. Like you want to spread it out. And yep, your vehicle must be used for more than 50% to get bonus depreciation. So keep that in mind too as well. And the rules change if the car is 6,000 pounds or less than 6,000 pounds.
Hey, it's Tabitha. I got a quick, I
Mhm.
went on your website to sign up for my tax preparation this year. I don't know if I overlooked it, but I didn't see it. I just saw the consultation.
Mhm.
So I need help moving forward for 2025 because there's a lot going on, and I
Okay.
need my taxes done for last year, and there's a lot going on with that too.
Okay. Yeah, yeah, definitely.
So,
I'll shoot you a message.
okay, cool. Appreciate it.
Yep, no problem. And the Max, did you have another part to add to that? Lab?
Um, Yeah, no.
Okay, got you. Just wanted to put that. Okay, I got you. And then
Yeah.
Max, your question was based on the asset, amount of asset. It's based on the fair market value of the asset. So not how much you spent, it's the total purchase price. So if you, like I say, put $10,000 down for a car and it costs 50K, that was what's on the closing paper on the loan, or for the rental property, that's the value that gets depreciated over time. And there are caps with the Section 179 and depreciation. And like I said, that number keeps phasing out. But we can get more technical depending on the asset you're trying to purchase, because some has a 5-year depreciable life, 7-year, 10, 15. So it varies, Max, and I can break that down to you. Okay, cool, cool. And I think unless anybody has any more questions, I'm going to see the questions that people had initially. Kevin, that was a funny question. At what stage in your business would you suggest hiring a CPA, payroll taxes for kids? Should I buy a car this year under your business? The car, since we're on the topic, I think someone asked that question, should you buy within your business? So I just want to remind you all that you do not need to have a car in your business name to take the deductions, right? When you do that, your insurance price, well, some people you need to. If you're in an industry where it's like I transport people back and forth, but obviously you want to put your car in that business name so you can get that extra layer of liability, legal liability protection. But like for me with an accounting firm, or someone who has a business and it doesn't require like clients being back and forth in your car, it's perfectly fine to have it in your personal name. You just need to keep track of the mileage. And it's the beginning of the year, right? So one of my tricks is either you do the mileage method, super simple. How many miles you drive for your business? Times about 67 cents last year, that's your deduction. Or if you know you use your car for 50, 60, 70% business, take a picture of your odometer today. It's the first month of the year. Look at it at the end of the year. And one shortcut there is you can kind of figure out the percentage of it based on the amount of miles you drove. The only time I've ever heard of people getting audited, one of the popular reasons get audited with cars is that they say they drove 20,000 miles. And then when they look at the oil change papers or they look at the odometer, like you didn't even drive 20,000 miles in the last 3 years. So just keep track of mileage, easy tax deduction, but also easy way to get audited. So keep that in mind. So yeah, if that's it, any final?
One last question
Oh
for
yeah,
me.
you take your time.
Um, do you trust the Fiverr bookkeeping entity, the company? Because to reconcile, set up, and create profit loss statements and balance sheets. Because when you're looking on there, you're searching for an accountant or bookkeeper. Most of them live overseas in Pakistan and places like that. So I'm giving you access to my website, to my um, bank account statements, to
Mhm.
my QuickBook. So do I continue to use? And then it seems like when I go back to get the same person, they're not available anymore. So now I'm getting a new person.
Yep, yep. It definitely, not having a consistent bookkeeper can kind of mess up the flow within your business. So I understand that. Do I trust Fiverr? I trust Fiverr if you've done your due diligence. What that basically means is you want to look at their reviews. You want to try to set up a call, a Zoom call like we're doing now. If you see that they worked with a lot of people, look them up on LinkedIn. Hey, Alex. Hi, Kevin. How was your experience working with this person? Like, do your due diligence. And if you find the right one, I trust it. But for you, as your business grows, like it's okay right now. What is it? January? Right, that's what we get into, right, Kevin? If it's January and you just need a quick cleanup and you got a very, very small business, less than $10,000, Fiverr may be a quick way to go to just give you some clean financials. But now it's like your business is growing, you start having more transactions, start getting more complicated. That's when you need to just find you a bookkeeper here in the US. We offer bookkeeping services too, bundled with our tax planning. But I trust Fiverr to a certain level. But the moment you start not trusting them or you start seeing red flags, just outsource it. Find somebody here that's not going anywhere. And that ensures accuracy and it ensures that the person you'll be working with will be reachable and obtainable anytime you need them.
Okay, and I'll follow Kevin's advice. I'm going to Wiggs.
Yeah, that works. That works. Yeah, definitely. Like I said, when
Thanks.
we talked last time, I got you.
Okay.
And then is that pretty much it? I think, Michelle, did you come off mute? Did you have a question?
Hi, Darian. Thank you very much. I was driving when you talked to me,
Yeah.
and I was on mute. I couldn't figure out how to get rid of that. So
Yeah, no worries.
yeah,
No worries. Definitely reach out. We still
yeah.
need to
This
connect.
was very informative session for us, and I also want to schedule another. call with you, just one-on-one meeting.
Okay, that works. That works. Yeah, we can set something up. But yeah, definitely. Yeah, thank you all for coming today. If you ever have any questions, definitely reach out. I will email you all my calendar link, and we'll also follow up with you when the IRS starts accepting returns. And as any major tax changes come up, as we do our research on it, I'll reach out to you all to give you more details too as well. So we'll definitely get something going. So yeah, thank you all. I'll send an email out in the morning, the recording, and hope you all have a wonderful evening and have a great year.
Thank you.
You
No
too.
problem.